Good morning, everyone. In the world of finance, risk can feel like a shadowy and unpredictable presence. It's a constant force that can erode value, threaten stability, and undo even the best laid plans. But what if we could draw a map of this shadowland? What if we could understand its topography? And that's what we are here to do today. We are going to be mapping the landscape of risk, focusing on understanding risk topology, not just what the individual risks are, but how they connect, interact, and flow into one another. My name is Dheeraj Chaudhary, and over the next few minutes, we will explore how to navigate this complex terrain to build more resilient and successful financial institutions. So, where do we begin? We start by acknowledging the shifting, almost living nature of risk. To manage it, we can't just react, we must build a structured framework. A robust risk topology serves as our guide. First, we must categorize our risks. We need to define and group them, moving from a vague sense of danger to a clear inventory of potential threats. Think of it as labeling every predator in the jungle. Second, we must assign accountability. A risk that belongs to everyone belongs to no one. Who is responsible for managing interest rate risk? Who owns the response to a cyber attack? Clear ownership is non negotiable. And finally, this framework helps us avoid blind spots. By strategically mapping our risk, we can identify hidden vulnerabilities and outline mitigation strategies before they strike. A well structured topology won't stop new risks from emerging, but they always will. But it provides the discipline and clarity needed to navigate an uncertain world. This brings us to the most critical lesson of modern risk management. Risks rarely act alone, they are not isolated events. Imagine dropping a pebble in a pond. Not only the point of impact, but ripples spread everywhere. The most significant financial disasters of our time were not caused by single risk, but by a chain reaction, a cascade where one failure triggered another. The most critical aspects risks are deeply interconnected. They flow and amplify one another. What starts as a single operational risk can trigger a liquidity squeeze, which then morphs into market instability and ultimately damage an institution's reputations and trust. For example, picture a bank dealing with a system failure, an operational risk. Suddenly, it struggles to access funds, becomes a liquidity risk, and clients, worried by the news of the issue, pulls their investments. Now it has become a market risk. The headlines drive away customers due to reputational risk, and soon the firm's survival is threatened. Financial institutions must understand not just individual risks, but their complex interplay and how a ripple in one area creates waves in another. Now, let's zoom in on the first major category, market risk. This is the risk that changes in the broader financial markets will erode the values of your assets. It is a risk powered by volatility. We can break it down into several key types. Liquidity price risk, the most straightforward. The danger of stock prices falling in a market downturn. Interest rate risk. This is crucial for bondholders. When interest rates rise, existing bonds with lower rates become less valuable. Foreign exchange risk. Anyone involved in international trade knows this one well. A sudden swing in currency's values can turn a profitable deal into a loss. Commodity price risk. The unpredictable movement in the prices of raw materials like oil, metals, and agriculture products. The 2008 global financial crisis gave us a masterclass in how these risks connect. What began as a credit and liquidity risk quickly spilled over into a market risk tsunami as asset prices across the board collapsed. But let's dive a little deeper into the nuances of market risk. It's not one size fits all. We can distinguish between general market risk, which is the risk that an entire asset class declines, like a stock market crash, where almost all stocks fall, and a specific market risk, where a particular asset underperforms its peers, perhaps due to poor company earnings. Then there's a more subtle danger, basis risk. This occurs when a hedge, that is your insurance policy, does not move in perfect correlations with the asset you are trying to protect. The classical example is an airline. An airline trying to hedge against rising jet fuel prices. They might use crude oil futures as a hedge. But what if a refinery bottleneck causes jet fuel prices to spike while crude oil prices remain stable? The prices have decoupled. The airline's hedge fails to protect them, and their insurance backfires, potentially worsening their losses. It's a powerful reminder that even our solution can introduce new risks. Next, we turn to credit risk, which I like to call the risk of promises broken. This is the fundamental risk that a borrower or counterparty will fail to meet their financial obligation. This risk appears in few forms. Simple default risk, where a debtor failed to repay a loan, or downgrade risk, where a borrower's credit rating drops, reducing the value of their debt. A critical form, especially in trading, is counterparty risk. The risk that your trading partner will go bankrupt before setting their side of deal. As an example, we can look at the collapse of Lehman Brothers in 2008. When they failed, they left countless counterparties with massive unsettled trades, sending shock waves of credit risk through the entire global financial system. To measure credit risk, we look at three key components: the probability of default, the likelihood they will fall, the exposure at default, that is, how much we stand to lose if they do, and the loss given default, what we actually lose after any recovery attempt. From broken promises, we move to a risk that can paralyze even healthy firms: liquidity risk, or what happens when the cash runs dry. This risk has two distinct phases. The first is funding liquidity risk. This is an internal problem. The firm simply cannot get its hands on enough cash to pay its bill and meet its obligations. During the great financial crisis, many banks that relied on short term funding found themselves completely cut off overnight. The second is market liquidity crisis. This is the external problem. You have assets to sell, but you can't sell them without accepting a massive discount, and you have to do it through a fire sale price. In 2008, even high quality mortgage backed securities become completely illiquid. There were no buyers at any reasonable price. Liquidity risk is often the accelerator in a crisis, turning other risk events into a full blown threat to solvency. Our next category, operational risk. It is the broadest of all. It encompasses any and all losses resulting from failed internal process, people, and systems, or from external events. This is the risk of failures from within. It includes everything from human error to outright fraud. Think of the rogue trader Nick Nelson at Bearing Bank, whose unauthorized trades single handedly brought down 200-year-old institutions. It also covers system breakdowns like data breaches and cyber attack, which are a top concern for every modern firms nowadays. It includes legal and compliance failure, such as breakdown in anti money laundering controls and devastating corporate governance scandals like the accounting fraud at Aarons. Because it's so broad and difficult to model, regulators like the Basel Committee have created standardized approaches to ensure banks hold enough capital against these very real dangers. Finally, we arrive at the highest level of risk, which involves strategic choices and trust. Business and strategic risk. Business risk is about day to day uncertainties like shifting customer demand. Strategic risk is about the big bets like major acquisition, entering new markets, or failing to adapt to disruptions like traditional banks being challenged by fintech. But intertwined with all of this is reputational risk. It is the most fragile asset. Trust can take decades to build and minutes to destroy. Often, reputational damage isn't a primary event, it's the result of failures in other risk domains. Look at the Wells Fargo account fraud scandal from 2016. An operational failure driven by a toxic sales culture led to massive reputational damage, costing the bank billions in fines, lost customers, and years of heightened regulatory scrutiny. Losing the trust of your customers and regulators can be the costliest failures of all. So, as we have seen, risks do not operate in isolation. They are part of a deeply interconnected ecosystem where failures cascade and amplify each other. This is the core lesson. A single credit default can trigger a liquidity crisis, which in turn can create market panic and ultimately destroys a firm's reputations. This is why a holistic enterprise wide risk management approach is essential. It's about breaking down silos and mapping these complex interactions. Firms that do this well do not just see risk as a hazard to be avoided, they integrate risk awareness directly into their strategy. By understanding the complete landscape, they can navigate it with confidence, build a resilience that becomes a true source of strength and a powerful competitive advantage in our uncertain world. Thank you.